I'm Tony Wickenden, and welcome to this applied learning programme on the government support schemes that are available to you. There has been, and it won't surprise you, unprecedented and much used word, interest in these schemes. So I think it's really important that you get to grips with how these schemes work, how you can access them if it's appropriate, but more so how you can explain them to your clients. Because where you probably won't be the person who goes online and helps your client make the application, it will be important that you have the information that your clients will want, the understanding that your clients will want when they come to you, hopefully as they will, to ask you about those schemes and how they work and whether they work for them. And if so, how do they get access to the funds, the loans, the grants, the money, the deferment of tax that's available to them. I've designed this applied learning program to give you the information you need in what I believe are the most important of those government help schemes, those arrangements that are now available to the businesses that can apply for them. You need to be on top of this. I hope that this program will help you be on top of it. So here we go, enjoy.
In the 16 days from the budget on the 11th of March, we had an unprecedented number of announcements made by the government to help overcome the economic damage caused by the coronavirus. These announcements were in relation to schemes and help set up for individuals and businesses. The underlying theme for all of the measures introduced to help individuals and businesses was that the government would do whatever it takes to ensure that the economy remained in as good a shape as it possibly could to take us through to the other side of the pandemic. The announcements made can be simply categorised into these three categories: grants, loans and payment deferral, and by payment I'm referring to the payment of tax. As this slide illustrates, there were a vast number of new acronyms brought into being by the Whatever It Takes initiatives, including the JRS, the Job Retention Scheme, the SEISS, the Self-Employment Income Support Scheme. We've had self-assessment deferment, VAT deferment provisions, and the continuation of the time to pay arrangements, as well as the CBILS, the Coronavirus Business Interruption Loan Schemes, and many more. My focus and our learning objectives for this programme are these: the Job Retention Scheme, the Self-Employment Income Support Scheme, Business Grants, Coronavirus Business Interruption Loan Scheme, VAT and Self-Assessment Deferment, and the Time to Pay Arrangements. These represent the areas that I believe you will have the greatest interest in, and I hope I'm right. There are three parties involved in the Job Retention Scheme: the employer, the furloughed employee, furloughed being a status where you are still an employee of the firm, not required to work but still paid, and HMRC. The scheme runs for 4 months from the 1st of March to the end of June. It was originally until the end of May, but it has recently been extended. Under the Job Retention Scheme, the employer continues to pay the furloughed employee. The employer then makes a reclaim under the Job Retention Scheme from HMRC. So it's important to note that it's the employer who makes the claim from HMRC, not the employee. The employer who pays the employee at least 80% of their pay can reclaim from HMRC that 80% of pay, subject to a $2,500 per month maximum for each employee who is furloughed, together with, and this is in addition to the 80% or $2,500, together with the national insurance that the employer pays in relation to the furloughed payment, and any minimum auto-enrolment contributions that they pay also in relation to the furloughed employee or employees. Let's have a look now at who can be furloughed and who can claim. First, who can be furloughed? Employees on the PAYE payroll on the 19th of March and for whom a real-time information and RTI return was made on or before the 19th of March. Those employees could be full-time, part-time, agency workers, those on 0 hours contract even. Those on sick pay can also be furloughed, but after their sickness ends, because during sickness they're not working and they'll be receiving sick pay either at the statutory level or at a higher level if the employer pays at that higher level. Also, those made redundant since the 28th of February can be furloughed, provided, of course, that they are re-employed. Who can claim? Well, employers who have created and started and ran a PAYE scheme on or before the 19th of March. It's important that the employer formally notifies an employee that they are being furloughed and that this notification is given in writing. The normal contractual conditions, whatever they are in relation to the employment contract, would need to be satisfied. It's the employer who then reclaims from the employee, from HMRC, and they can reclaim the lower of 80% of the furloughed employee's regular wage, or 2,500 per month. So that 2,500 per month is an absolute cap on the amount that can be reclaimed, plus employers' national insurance contributions and minimum auto-enrolment contributions. The amount that's referred to in relation to determining the amount of the furloughed pay that can be reclaimed from HMRC depends on, in relation to full-time employees, whether that employee is on a fixed pay arrangement or a variable pay arrangement. By fixed pay, I mean where your salary is known and you get the same amount each month, which is going to cover most people. For those, it's the actual salary they received on the 19th of March. For full-time employees on variable pay, then it's the higher of the amount received in the same month last year, or the average monthly amount received over the last 12 months. It's quite important to note that discretionary bonus and commission payments are not taken into account. But if there is an amount that's owed in relation to a past earned commission or bonus payment that you are now contractually entitled to, then this can be taken into account. There are a number of other questions that are typically asked in relation to the furlough scheme, the job retention scheme. And here are some of them. I think these are the main ones. When can a claim be made and who by? Well, the claim is clearly made by the employer and it's through a portal and they can make the claims from the 20th of April. No work must be carried out by the employee on behalf of the employer during a period of furlough. There are special rules for directors, which I'll look at in a minute. There's a minimum 3-week furlough period, and coming in and out of furlough is possible. So you must be furloughed for at least 3 weeks, but then you can come back to work and then you could be re-furloughed for another 3-week period. Not all staff have to be furloughed. So you can just furlough 5 of your 10 staff if you wanted to. It may offer the opportunity to run a kind of skeleton staff scheme fairly by furloughing 5 for 3 weeks of 10 and then bringing those 5 back and furloughing the other 5 for 3 weeks and kind of going on like that. That might be helpful for the employer to adopt that kind of arrangement. There must be written confirmation of the furlough, which I've mentioned already, and there could be multiple caps for multiple employments. You look at those caps for each particular employment. So if you had a couple of employments, you could be furloughed with one employer and not with another. So let's have a look now at owner-managers, shareholding directors. There's been a lot written about this category. Category of an individual who may draw money from their business by salary or dividends. Maybe all dividends, maybe all salary. But there are 2 ways in which these people can withdraw money from their business. Although there's been a lot in the press around this subject, it's very clear at the moment anyway that only salary is covered by the furloughing arrangement. It is not possible to refer to dividends. Directors can carry out statutory duties. You'll recall that to be qualified as a furloughed employee, you must do no productive work for the employer. In fact, generally no work for the employer. Directors can, however, it seems, carry out statutory duties, and one of those 7 statutory duties that are in the Companies Act is to promote the success of the company. So what does that mean? Well, the Revenue HMRC have given some guidance, and they state that there should be no work of a kind that the director would normally do to generate commercial revenue or provide services to or on behalf of the company, which would seem to rule out any kind of productive work being carried out by the director if they want to furlough. Some questions have been asked as to whether they can continue to do some of that productive work in their capacity as a shareholder, and they clearly cannot be furloughed as a shareholder because they are not employees as a shareholder. When they act as a shareholder, they're someone who has provided money for the company, is an investor in the company, who owns shares in the company. So what work could they do, given that they can't receive employment income in relation to their activity as a shareholder? Could they do other productive work? It seems from the guidance that the likely answer to that is no, but at the time of recording we don't have that answer. Let's turn now to the Self-Employment Income Support Scheme, and we're going to look at this by asking the questions: who can qualify for the SEISS, how much can they get, and how do they make the claim? Who can qualify? Well, anybody who's self-employed or a member of a partnership, including an LLP. That person must also have submitted an income tax self-assessment return for 2018-19 tax year. They must be trading on application, or would be but for COVID-19. And here's an intention test: they must intend to trade in tax years 2020-21. The government want to support viable businesses. There's also a condition: they should have lost trading profits due to COVID-19, although at the point of recording it's not clear as to how that loss would be measured and when it would be measured. There are some other important conditions too. The person claiming must have had self-employed trading profit of less than 50,000, and that trading profit, that self-employment income, must represent more than 50% of their total income. But for what years? Well, for one of these two periods, they can satisfy that less than 50,000 trading profit and more than 50% of total income in relation to self-employment income for either of these two periods. The first, 2018-19, the 2018-19 tax year. And the second, the average self-employment income was less than 50,000 for the periods 2016-17, 2017-18, 2018-19. So add all of the trading profit for those periods together, divide by 3 and see if it comes to less than 50,000. That would also allow you to tick the box of your profits being less than 50,000. So you've got two opportunities: your profit less than 50,000 in the 2018-19 year, or that average profit for those periods being less than 50,000. By the way, if you've only traded for two of those years, say 2017-18, 2018-19, it's the average of trading profits for those years that's taken into account. Of course, for whichever year you select as the one you're going to go with, you also in that year need to be able to prove that your self-employment income represents more than 50% of your total income. So how much can be claimed? Well, this is a little simpler. 80% of average profits from the tax years 2016-17, 2017-18, 2018-19, or two of those years if you've only been trading 2 years, or just 1 year, 2018-19, if you've only been trading for that year, subject to a maximum of 2,500 per month. And it's also really important to note then, though, so that if you don't have a self-assessment return and you weren't trading in any of those years, then you just can't claim under this scheme. So when can you get your money under the Self-Employment Income Support Scheme, assuming you qualify, of course? Well, it's for the HMRC to invite you. They will be assessing their records, and then they will be inviting qualifying self-employed people to claim under the scheme. So there's nothing you need to do or can do at the moment. It's a case of don't call us, we'll call you. The call will be given to you, the invitation, late May, according to HMRC, for you to make the claim in June, and the payment will then be made as a single taxable sum. So let's have a look now at business grants. There are two types of grants I want to consider and that are available: the small business grant and the retail, hospitality and leisure grant. The small business grant first, it's £10,000, one-off payment, non-taxable, available for all businesses that qualify for small business rates relief on property. That is property with a rateable value of £15,000 or less, or if they qualify for rural rates relief. Now, the retail, hospitality and leisure grant is available for businesses in any of those sectors. The amount available is £10,000 on property with a rateable value up to £15,000 and £25,000 with a property of a rateable value between £15,001 and £50,999. That is between £15,000 and £51,000. The grant is tax-free and it's a payment, it's not a loan. It's not available for businesses that don't directly pay business rates. So if you had, shared premises, a WeWork type thing where you're not the one responsible for the business rates and eligible for small business rates relief, or you're in one of those other sectors. If you're not actually the one paying the rates, and you're not the one on notice for paying the rates, then you can't qualify under this scheme. So basically, if you don't have a premises, or even if you work in a premises but you're not the one paying rates, you're paying a sort of composite fee for the use of those premises, typically like a WeWork type arrangement, you won't qualify, unfortunately, for this grant. Now, the grant's administered by the local authority and they will be funded by the government. So it's the local authority that you'll need to claim from. There's very clear guidance on this on the HMRC Gov website. Plus, for businesses that qualify, business rates holiday is available. So you don't actually have to pay any business rates. So you can get the grant and not pay any business rates for 12 months for businesses who are in hospitality, leisure, retail, estate agencies, letting agencies, and bingo halls. So we'll turn now to the coronavirus business interruption loan scheme. The aim is very clearly to provide finance quickly to support the economy, jobs and business. There's been some negative press around this, particularly in relation to the speed of money being made available under this loan scheme and the difficulty in actually being able to get one of these loans. Hopefully this will be smoothed out and the process will become smoother and quicker as time goes on. Hopefully not too much time, because the important recognition in the design of this scheme in the first place is that cash is absolutely king for most businesses. So the fundamentals of the CBILS, it's run by the British Business Bank. That bank doesn't lend money but organises more traditional lenders, of which there are over 40, we understand, to make the money available. The money is available to businesses that are small under this definition. That is businesses with a maximum turnover of 45 million. Not that small then, but so that's the term, maximum turnover 45 million. The maximum loan that can be made is £5 million. The loan could be whatever is appropriate for the reason that the business needs the money. It could be a term loan, it could be an overdraft. Importantly, the loan is interest-free for 12 months, and that's incredibly attractive to the borrower. And it's 80% guaranteed by the government, which is incredibly attractive to the lender. You can apply for a CBILS loan even if you qualify for a commercial loan. Usual evidence will be required though, remember that. You'll be asked for accounts, a business plan, a repayment period, proof that you can afford it. These loans are meant to be made available to viable businesses who are just being hit temporarily or having to go into a kind of temporary hibernation because of COVID. Remember also though that it's a loan and the borrower remains liable. But, it's an important but, the banks can't, or the lenders can't ask for a personal guarantee for loans up to £250,000 and only a 20% guarantee for loan amounts over £250,000, unsurprisingly, because the government is, after all, guaranteeing 80% of the loan. As a result of some criticism of the coronavirus business interruption loan scheme, the CBILS, a new loan scheme was introduced, the Bounceback Loan scheme. Effectively, it's a micro-loan scheme. It's available from Monday the 4th of May, and it's 100% guaranteed by the government. You may recall that some of the criticism of CBILS was around the guarantee, it only being 80%. The government felt that it will be unwise or not right to guarantee 100% of all loans, so they have restricted this guarantee to bounce-back loans, but it is 100%, which will be a great source of reassurance to lenders, I'm sure. Now, the maximum loan under the Bounceback Loan scheme will be 25% turnover, subject to a maximum of £50,000. So in effect, the lower of 25% of your turnover, presumably turnover as recorded in your last set of accounts, and £50,000. So the lower of those two amounts. The minimum amount you can borrow under the Bounceback Loan scheme is £2,000, and the term will be up to 6 years. From the borrower's standpoint, the fact that the government will pay the interest under this loan, so in effect for the borrower it's interest free, and will pay any fees for 12 months, and a low standard rate is to be agreed to take effect after that first 12 months period, will be very attractive. Also, incredibly attractive, no repayments are required. I mean, you can make them, I guess, but no repayments are required for the first 12 months. So that's interest-free, fee-free, and repayment-free for 12 months. Now, there's no outright test of business viability, but the business should not be one that is an undertaking in difficulty, as at the 31st of December last year. The funds will be apparently made available shortly after approval of a loan, and the application process is designed to be simple on a standardised application form. It's also noted that CBILS loans can be converted to bounceback loans up to 4th of November 2020. So if you had a CBIL loan and it was within the conditions of a bounceback loan, you could, if you want to, and you probably would because the terms of the bounceback loan are a little more attractive, you could convert it to a bounceback loan up to the 4th of November this year. The government have announced a new death in service benefit for frontline workers. This will pay out a lump sum of £60,000 on the death of any frontline worker due to COVID contracted in the course of their frontline work. So this cover will be available to cover the death of National Health Service frontline staff, care and social workers, that's people delivering care, both adult care and child care, GPs, dentists, and even cleaners and porters in a care environment. The scheme is time limited, effectively for the time of the pandemic, and one can, I think, safely assume that there will be no adverse direct or indirect impact from this scheme on tax or benefits, any aspects of those. It's also important to note, I think, for financial planners that the introduction of this scheme should cause us to think a little more carefully around the extent to which individuals who are clients have sufficient life cover to provide the life, that the financial life that their families, that they would want their families to have should they die. Not through COVID, just should they die. It's this whole pandemic has caused us to think again, maybe in a little more detail and with a little more focus around general wellness, well-being and our own mortality. So I think it's a good time to talk about, in a sensitive way obviously, but to talk about the importance of providing sufficient protection for your family or for your business. So payment deferral now, deferment of VAT, deferment of self-assessment payments, and then the time to pay scheme. VAT first. For periods between the 20th of March this year and the 30th of June, there's absolutely no need to make a VAT payment. I mean, make it if you want to, but there's no need to. You can defer the making of that payment until the 31st of March 2021, and it's interest and penalty free. The return should be submitted, but there's no application required to defer, just don't pay. Information on how you will eventually have to pay the outstanding VAT, because you will remain liable for it, will be available in due course according to HMRC. You could look at this arrangement as a kind of interest-free loan. If you've got the money available and it should be paid to the government are now saying you don't have to pay us. They're effectively letting you retain the use of that money for quite a long period, right through to 31st of March 2021, as I mentioned, without interest and without penalty. So it gets you to be able to retain the use of that money without having to go possibly to the bank to secure a loan. So self-assessment payments due on the 31st of July 2020 can be deferred until the 31st of January 2021. As for VAT, interest and penalty free. As for VAT, no application required, just don't make the payment. It applies to all self-assessment payments as well, not just to the self-employed. There's also the time to pay scheme, which has been with us for a number of years now. It's the ability to enter into a effectively negotiation or discussion with HMRC, laying out why you're unable to make a payment of tax that isn't already covered by those two other deferment arrangements, those unilateral deferment arrangements I've just referred to, VAT and self-assessment. So it could be in relation to corporation tax. So you'll need to make your case, have a kind of business plan, and to put forward a reasonable repayment period and a schedule that HMRC think is reasonable, and that you then adhere to that. The phone number to call to have a discussion around this is 0800 024 1222. But be prepared, as it were, to have full justification for why you can't make the payment and how you propose to make the payment instead. So my focus throughout this programme and our learning objectives is to look in some detail at the job retention scheme and how it works, the self-employment income support scheme and how it works, business grants, the coronavirus business interruption loan scheme, and then VAT self-assessment deferment and the time to pay scheme. Hopefully you have achieved those learning objectives, and it remains for me to say the very best of luck and stay well.
Well, I hope you enjoyed that applied learning program, and more important, that you got something from it and got from it what you needed, what you felt or feel that you need to give your clients the support that they will, I think, inevitably be asking for, or maybe now asking for, because you have that information to give to them and make them aware that you have that information. I would say to you, though, that those schemes are being not endlessly, but regularly reviewed and updated. And so I would encourage you to go to TechLink under the whatever it takes section, and in particular to have a look at the matrix that we are keeping as up to date as we possibly can, with every nuance, with every change that's being made to those schemes. So go to TechLink to keep up to date.